And welcome, everyone. It is Angelo Robles of the Angelo Robles podcast and Family Office TV. I hope all is well. We're excited to do this as yet another live, also being recorded, and will be a little bit polished up in nice thumbnail and up on my YouTube platforms, which by now you know I have two. My long established with about 11,000 subscribers at Family Office and my newer Family Office TV. I recommend subscribing to both and other platforms because there is or will be proprietary content specific to each, and to get the full breadth of what we talk about in economics and macro and family offices, that is how you would do it. And I'm sure, of course, you're following me on all other platforms like LinkedIn, like even Facebook. But yeah, why not? You'll find me. It's by my name. And Twitter, where I'm starting to get a little more active, and that's at Family Office as well. So I've been really excited to be doing these lives again, perhaps as soon as next week or the week after. I'm going to condense them a bit, likely just do them one day a week. And more of my content will be specific to my platforms that you got to subscribe to and go up. And really, some of Family Office TV, kind of the behind the scenes and really deep, direct questions that maybe we don't want up in a public platform, especially on investing and geopolitics. You kind of have to be a subscriber. So as you heard me say before, next Tuesday, August 15th, finally, my new website, the one now is a terrible brochure. Don't even look at it. But angelorobles.com goes live on Tuesday, truly goes live on Tuesday, August 15th, and everything will be outlined there. And I'm so excited. I have a lot going on. I'll be traveling the world, talking to billionaires, meeting with a truckload of family offices. I got multiple consulting and other engagements on the docket, both domestically and internationally. And I look to take all of you partially on some of that ride that I'm going on, and hope to educate and provide value in an area that many of you are looking to get more information, and not have it be superficial, but have it be with the level of intellectual rigor and depth that I think you all deserve. So today we are going to cover Family Office global investment trends. And I have a great guest. I've been a fan of his for a number of years, connected more personally just a couple of months ago. We're both part of like a private group of, I guess you could say, thought leaders in the community where we learn and share from each other. And that special guest happens to be Abbas Hashmi. Abbas, how are you?
I'm doing well. Thank you, Angelo.
So great to see you. I know you're in beautiful Long Island. You got a great backdrop there. I'm in my studio. I got a gray backdrop. It does not look quite as cool as yours. If you have a glass of wine, then I am going to be very jealous.
Well, you can green screen your background easily. A gray screen.
Yes, and I actually have a green screen that I don't seem to like to use. I don't know why. I guess this is au naturel. But those of you that saw my Mark Faber interview, which was one of my most viewed videos, probably about 70,000 views of all time for me, about 6 months ago, it's up on my at Family Office platform. And I've known this from interviewing Mark before. He starts to grab cigarettes and beers, and he's drinking, and he looks like Santa Claus. And I just love the guy. I think he's great. But I was ready for him this time. I got my cigar lighter right here, just in case you were to light up. I got my cigars. I'm a pretty big cigar smoker. And I got my whiskeys and my drinks. I enjoy every now and then, not too often, a good drink. So who knows what future lives and podcasts and interviews may hold, and you could have tempted me with a glass of wine. But Abbas, on that note, so in case the audience, and I don't know how this could ever happen, but if they're not familiar with your great work that you talk about and what you do, you're one of the best writers in the community on global investment issues. I love your LinkedIn, and we're going to get to all that, how people should follow you a little bit later. But the very brief is, Abbas is the Chief Strategy Officer for BAM Companies in Indiana. I mean, I should talk Wyoming, right? Although at this moment, technically for a couple of weeks in the wonderful state of Connecticut. Welcome.
Beautiful.
And BAM is a vertically integrated real estate operator and single family office that makes Abbas a little bit extra unique, which is why we're excited to have him as a guest. More recently, He was also head of digital launches at a company you may have heard of, Goldman Sachs, for personal wealth and family office clientele. Before that, Abbas ran an international consultancy focused on investing in US real estate and infrastructure. And to add to it, he was at a competitor of mine, even going back a couple of years ago, when I first heard about his legendary status and the great work that he was doing. He led membership expansion for private ultra high net worth clients via the platform of what likely is the world's largest single family office here. So, Boss, again, I know I jumped the gun a little bit before, but for a second time, welcome. It's a pleasure to have you on.
Thank you, and thank you for such a wonderful introduction. You did it better than I do usually. Thank you, Angela.
Well, I don't know about that. It's a Monday. I didn't maybe do my best pronunciation, but I am full of vigor and energy. So you definitely got that out of me. And for the audience who's wondering, I don't know why I get all these comments. Like, it's never comments about the intellectual prowess of our questions or discussion. But to make all of you happy, yes, I have other than dark blue and gray double-breasted and even traditional suits. My God, I'm taking out my fall outfit. I got my brown. Who does brown anymore? I got a brown. Of course, it is double-breasted, my favorite. So I don't know how the colors pick up so much on a live or on the recording, but I know that for those that think I only own two colors, you are wrong. At least it's three.
You'll have very to chic. Very,
watch
very
a future one to know more. Well, thank you, Abbas. Thank you. So let's get into it. We'll build a little bit of the story with your experiences being very international and how families are allocating, what they're interested in, how they're investing. So that's going to be really exciting. But I think it helps to build a little bit of a story with your perspective and your experiences. And importantly, and this is what I try to do as well, we have our hand on the pulse with at minimum hundreds of families that we talk to and interact with, and what we learn from, and sharing to the audience what they're thinking, I think is insightful for those moving forward. Why don't we start with the almighty dollar? It's been the almighty for a long, long time. Go back to Bretton Woods in the mid-40s. Of course, we could have 1971 going off the gold standard, but effectively every country effectively did that ballpark either prior or even after that. So like that's, unfortunately, that's kind of the norm now. And last year, the dollar in a horrific market for everything else did well. This year, well, it depends. You could argue a little more challenged, net of inflation and taxes. So why don't we start there? And I'll throw a little monkey wrench into it. The US dollar hegemony. I think for a change, I might have pronounced it at least close to being right. For those of you that don't know, look up Michael Hudson. That's Michael Hudson's Super Imperialism, describing effectively an asymmetrical relationship that the US dollar has to the global economy. To think that the US dollar is going to reign forever, I think appears foolish. It is the king. It's the one-eyed giant in a land of the blind, I guess you could say. But that being said, what are you hearing from the families, especially globally?
I think families, number one, thank you for giving me this opportunity to talk about a global family office landscape, politics, impact. And then from that lens, if I go back to the times, and I'm not going to bore you with my childhood stories. I was born and raised in Saudi Arabia. So everything growing up was either American or local. And there was nothing in between. So there was no China, no Europe. Everything was America or Saudi. And then growing up, I've seen this sentiment attached to American dollar that obviously stems from a number of soft image elements, including Hollywood, including big brands like Citibank, or if you look at late 90s, CNN as well. So all of that contributed towards that sentiment that dollar is, if not the only, but the second most important currency in that part of the region. If you zoom out a little bit more, I've worked in Singapore as well. That is another region that considered dollar to be one and only after the local currencies. And there is a sentiment that if something happens, if a local government fail, or if the local economy has challenges, local currency is getting weaker and weaker in comparison to US dollar for several reasons. It can be geopolitical reasons, it could be economics, it could be just pure balance of trade. In that situation, I've seen people move their savings or at least their livelihood into US dollar. And that has been the case for some time. Now, over the last several years, Uncle Sam has done several geopolitical moves that has created the sentiment that US dollar is good, but US political involvement is not good for local politics. And that used to be two different buckets. And now, as we are getting into this new economy with social media, people are getting together on different platforms. This is becoming more of a movement. And I'm seeing that in different parts of the world where there is a deliberate push away from US dollar into either alternative currencies like crypto and so on and so forth, which is still very new internationally. And then towards discovering an alternative mode of payment. And that's where we were talking about BRICS, and we're talking about a few other movements. Chinese yuan has been a competitor for a very long time, as long as I know.
I mean, I could look at it and paint, I guess, a bleak picture. One, it's had a great run, so kudos. The US is still an amazing country, although not without its challenges. We have a massive deficit. That is one problem. We have a extremely worthy and powerful competitor in China, as well as collectively other countries, especially banding together. We could argue when the EU was formed, that was going to be looked at as I don't know if I'd use the word competitor. And to some aspect it was, and maybe in others it arguably might have fell a little bit short. But there's dynamics going on geopolitically around the world, the challenges that we're having in this country. I could argue that the US has exported inflation basically to the world, and probably make a hell of an argument that, yes, that is the reality of it. And no question, through sanctions and other forms of covert and other manipulation and three-letter agencies, the US will absolutely do anything to maintain its power status. And come on, of course, that includes, even if quasi indirectly by force, but inevitably the world does turn and things change. So what would you potentially look at as a nexus for when the dollar could no longer be the reserve currency? And by the way, I had a couple of very smart guests on, Jared Dillian and others, that say, yeah, you're right. And that right may be decades from now. And I'm not so sure that they're wrong. Mm-hmm. But there is the rise of the BRICS, mainly with China and Russia, but other countries and others joining in, and possibly the Saudis accepting other forms of quote unquote payment for oil. So there's unique dynamics at work that they may also back their collective quote unquote currency by some form of a commodity. And I think we are looking at, for the first time in truly forever, a competitor to the US dollar.
No, you're right. My opinion is a little moderate. If you compare it from, say, 1970s or even before that, then obviously it's a drastic position that I don't think so we will see the same time again. But total elimination of dollar from global trade, or countries that are aligned right now or in future with US due to changing geopolitical situation, will move away from dollar. And it has to do with a number of things. Obviously, oil and gas being one of them, have dollar being the leading currency or denominator for these kind of international trades. But at the same time, looking at it from the economy size point of view as well, a number of countries call US or US of A to be their biggest trade partner. And if this is the case and US is dictating the currency of trade, then I don't think so it will go away anytime soon. Having said that, China and India are formidable competitor. They're still not at the same size or sophistication or infrastructure where US is, but nevertheless, they have started the race and they're in the game. And I foresee this particular gap will continue to narrow between these two currencies or these two nations and US dollar. As compared to, like, if I compare that with GCC or Middle East or Asia Pacific, I'm still on the fence. I'm not sure if moving away from US dollar will help them in any way. There is more to lose when it comes to protection from the big brother or family member and letting go of US dollar than like considering, I don't know, dinars or reals or baht to be a currency of choice. But you never know. Things may change, but I don't think so they will change that drastically.
Yes, although I may try to rattle that cage a little bit, the reality is if you were to press me on that issue, broadly, I would agree with you. I'm reluctant to give a time horizon as to when possibly a dent in the dollar could be. But I could say, is it possible that it happens within the next 5 or 10 years? Of course. And think of the impact on U.S. treasuries and debt, the U.S. government, and the impact to the world. So reliant on the U.S. dollar, that could really, really turn things upside down. And I know my audience knows, my families that I consult to, I do tend to look at kind of what could go wrong. Mm-hmm. I look at what could go wrong when the impact of what could go wrong is not nominal. Oh, well, things are a little tough. Oh, well, we go down 5 or 10%. I could argue, who cares? What I care about are the things that could be truly asymmetrical from a negative perspective, and things could go really, really down. We may have enough time to get into building into our story about global investments, about how in the US and to some degree, even other parts of the world, especially the West, we are way too dollar denominated. Think of our stock market, think of our bonds and our cash portfolio. And I can't give you a timeline. Maybe it is 40 years, maybe it's 3 years, where that could drop a lot. And I mean a lot. And if you built $1 billion family and family office and you're not considering hedging and understanding these risks, and I can tell you, you're not. Your advisors, no one's bringing this up because it's uncomfortable, and it's probably, one, they don't know what they don't know as well, and it's probably not profitable to their enterprises and what they're doing. So there's a whole bunch of crap going on that I think families and those that advise them have to get their head out of the sand and understand when things go bad, as I could be describing it, and you're getting the tip of my iceberg, they could go real bad. Let's talk a little bit about some warning signs. Historically, we're in an inverse yield curve now, meaning our short-term treasuries, the interest rates look pretty darn good, actually. Long-term, not so good. Historically, that tends to lead to bad times ahead. Yeah, maybe it rhymes. It's not perfect. Who knows the timeline? But if you had to try to put on your economic hat and take a look even out through the end of this year into next year, do you think we could more formally, assuming we're not in one now, head into more of a downturn and a recession?
I will look at it from an LP or an investor perspective. So if you look at the current situation, which is ongoing ever since 2020, there has never been a position where investor can say, okay, this is the status quo. I'm going to maintain that, and let's plan backward based on these signals. Since 2020, COVID, low interest rate, high interest rate, continuing to rise, and then still having no sense from the Fed where these interest rates will go or whether they will go down, family offices and ultra high net worth individuals are sitting on the fence, and which brings us to another point possibly later in the conversation about allocations and dry powder. If I'm a family office, I really want to have some sort of certainty. And when I say certainty, I've recently learned a new word called high conviction, and I will uh, award uh, the colleague who introduced me to this word, and I'm going to use this conviction terminology for reference. I can say with pretty certain conviction that I am seeing recession starting somewhere around January, February, and that's from the point of view of mindset, which has been brewing for some time. And now, by the time we get into January, if nothing has happened, when I say nothing, that means if there are no positive signals from the market or the market makers, we will possibly see situation deteriorating and family offices possibly doing one of two things. Either they're getting in and being more opportunistic, but traditionally speaking, family offices align themselves with preservation of capital and legacy building as compared to more private equity-ish or opportunistic moves in a wholesale fashion. So that's my understanding of what's happening. Internationally speaking, we haven't seen any impact yet, or at least not as major as we are seeing in Europe and US, especially in Asia Pacific and Middle East, and partly because of high oil prices and the momentum that they have built. But recession or talks about recession in US usually are a leading indicator for international markets. So I foresee that coming. I foresee us coming out of it sooner than the international markets, and that will greatly impact the allocations of family offices and high net worth individuals.
I know you may be more of a private markets, real estate, and infrastructure guy when we dive a little bit more into the investment angle. But earlier this year, we absolutely had a scare here in the US relative to multiple banks, some rather very large ones going under, and the system effectively having to quote unquote support it, which concerns me in terms of looking a little deeper below the surface. We all know that if even a tiny percentage, relatively, of Americans, especially on the upper end, wanted to go to the bank and take their money out, and they all try to do it at the same time,
Yes,
you're not going to like what you're going to find, which is absolutely a reason for concern. The subject of another topic on my disaster prep for billionaires for another time. So this led to some tremendous opportunities in so-called too big to fail, and JP Morgan being an example. But that being said, and I know it's probably more of a public markets question, but broadly also from a little bit of a economic quasi geopolitical perspective, do you have any thoughts about what is brewing beneath the surface with banks and the impact broadly from crypto to Web3 to central bank digital currencies? Like, is there going to be a future for smaller banks?
A very good question. From the point of view of let's look at it from the maturity mismatch. Most of the how can I say that for the audience? Most of the commitments that banks made to their customers were higher interest yielding based on different instruments that they had, based on different products they have. But when it comes to banks parking their own money or trying to diversify their portfolio, they have been shortchanged by the U.S. Treasury. And if you look at it in long term, I don't know how they're going to finance their short-term commitments if there is another run for the money when it comes to smaller banks. So thus, I feel there is an opportunity for larger institutions to either acquire smaller institutions or smaller institutions getting together and creating formidable competition for the usual JP Morgans and Wells Fargos of the world. From an investor point of view, a lot of international family offices, high net worth individuals who are keeping their money in U.S. banks for several reasons, including sometimes trade financing as well, sometimes opportunistic acquisition in real estate or any other private equity deals. For the first time, they realized that banks can fail in US as well, and at a retail level. So there has been this question across the board as to which bank should I move my money to, because they definitely don't want to move the money back to their home country for several reasons, including political. So they would rather keep that money here, but which bank? So that's a conversation that is ongoing, and it will continue to happen as we pass through this cycle. But I'm glad when I look at the regulatory framework and what has happened in 2007, at least it's not repeating itself right now. It was a calmer, I wouldn't say softer, but a calmer landing for a bunch of institutions that were under the lens of either you say regulators or international investors. So that's my take on it. It's going to take some time to consolidate. There will be some formidable players coming out of this whole scenario in the next few months or a year. And then from alternative to the conventional banking system, if you look at crypto or Bitcoin, my previous employer, GS, did not appreciate that. I mean, they accept it, but they didn't appreciate that. I cannot comment on their behalf. But when I look at the ecosystem, that is continuing to grow. Unfortunately, there is this aspect of crypto or alternative currencies or DeFi as being more of a store of value than transaction and trade. Unless that happen, more like streets of China, streets of US, unless that is happening, it will be an uphill battle to make crypto or alternative currencies mainstream in the next, say, 3 to 5 years. Now, all the infrastructure that is being built underneath those currency systems, that is extremely valuable.
Yes.
That is whether you talk about blockchain or any other kind of platforms, those are valuable for innovation, development, and building out things that we don't even envision right now when it comes to payments and settlements.
Yeah, I mean, I don't want to derail the conversation to make it crypto-centric. My audience knows I went through that phase. I overdid it. I over-allocated. I did put my money where my mouth was. I put too much of my money where my mouth was. But still, that being said, the majority of family offices, both the principals, maybe the young ones do, but the principals and the executives, you have no clue. You are totally lost on the true opportunity of the underlying technology, not just the blockchain, but of Web3, the creator economy, and the future that a lot of that is going to hold, including the tokenization of assets, and unfortunately aspects of it going into central bank digital currencies, various platforms and blockchains that they're going to use, and how the future of banking, like everything, is going to be turned topsy-turvy. And that's not going to take 20 years. You know, that's going to happen much, much quicker. And again, I go back to, as a family office, a lot of you, you're way behind. You are way behind. Okay, I'll get off my soapbox for a minute. We'll come back to it.
Nick, go ahead.
Yes, I'm sorry, Abbas, please.
I was just mentioning, when it comes to Asia Pacific, I see larger or more interest from that region when it comes to cryptocurrency and all of that as compared to any other region. And I think part of that is an understanding that we're not talking about crypto or currencies. We're talking about the underlying system, whether those are helping healthcare, whether those are helping international payments relating to art, for example, things like that are more, I would say, not in the mainstream family office space, are getting more traction internationally, especially in Asia Pacific.
No doubt about it, which is one of the challenges that we're having. To some degree, we're driving innovation away. I could argue with onerous regulation, which appears to be quasi on the horizon, and a lot of young, very smart people. I admit it's not maybe quite what it might have looked like a year and a half ago. I get it, but are trending in that direction of they're not, one, it's getting harder and harder for them to come here, but two, or to stay here if they go to school here, and the opportunity of taking what they learned and having more freedoms, which who would have thought in their own country, is just not a good thing for the US and the West in general looking long term. So again, and and you all think I'm only on one side of the aisle. Both aisles make mistakes. And I think one of the mistakes on the Republican side, and where I disagreed with Trump, and I know many of the quote unquote conservatives will disagree with me. You agree with me on what you want to agree with me on, but when you disagree with me with something, it becomes really intense. We're making lots of mistakes on the immigration front. I'll leave it at that. We'll have more discussions that intertwine that with geopolitics in the future. But back a little bit to banking, to cash, and a little bit to the words dry powder that you used before. Let me know if I'm wrong, which I might be. Is it overly simplistic? Why do you want to have your cash, unless it's super liquid, like you need it today, tomorrow, next week, at a bank earning nothing, arguably some degree of bank risk, when you can have it in a short-term treasury, earn way more interest? And although I bitch and moan about the US government, it's probably more secure and backed than banks. Where am I wrong?
So if you look at it from international perspective, I'll give you an example. When it comes to Middle East, say Saudi, UAE, Qatar, Bahrain, Oman, these countries have very robust government supports available to local banks. At the same time, they have pretty strict regulators as well, who are continuously monitoring the liquidity requirement and ongoing operations of these institutions, because a lot depends on these institutions when it comes to international trade, when it comes to local livelihood, political stability, and all of that, and especially optics. So if you look at it from that point of view, it is both a personal choice and a political choice to keep the money parked in those banks, as compared to instruments that are moving money outside of that particular region. Same goes with Asia Pacific as well. Same to some extent goes to Africa as well, because they want to keep the money locally in their economy. Why outside and why not in deals? Because of the start and stop nature of this particular crisis. Started off in 2020. It's one of the longest recession conversation, at least in my lifetime, I have seen that it's happening, it's not happening, somewhat happening, it is happening right now, we're in the middle of it, or it is ending. So all of that confused or misty, hazy situation is creating this sense of fear amongst the family office allocators. But at the same time, being family office, I mean, obviously you have to be entrepreneurial as well. Most family offices are sitting on top of operating businesses. There is that aspect of, let me be the smartest kid in the room. So let me keep my money in my pocket. The moment ice cream shows up, I'm the first one who will stand in the line and buy. So that's the I think more behavioral finance aspect of it. But yes, there is a cost to that, and most family offices run either on operating businesses that are underlying those family offices, and some of them that are a little bit more sophisticated run on the investment income that these family offices generate. So if the economy is right in that particular market, and they're making enough money to keep their family office afloat, pay the salaries of family office executive, then they're fine. They can sit on the sideline for possibly 3-4 months longer. But if it's a family office, and I say 3-4 months longer because recession will hit their underlying businesses as well, unless they are in a business model that is not impacted by this recession. On the other side, if their family business or family office is entirely dependent on investment income, then there's so much that you can do. I mean, there's a cushion that you have maintained for some time, and it is running dry now. So I foresee if the market doesn't correct itself, or if it continues to stay like that, then as we enter the recession, possibly we'll see a little bit more allocation increase from family offices in opportunities like commercial real estate, for example. Multifamily, that's another thing that is considered to be at risk, but it is not Commercial real estate, you have to slice and dice it into different sectors, whether it is industrial or office and so on and so forth. So all of those conversations are currently happening. It's just that who's going to move fast and going to call it a day and say, listen, we are already in recession. This is the lowest that we can get. Let me allocate some money before my CEO or CFO leaves.
Excellent, actually, commentary. So I'm going to let the audience in on a simple secret that I think we all know, but sometimes you just don't hear from the super rich, and maybe not as much billionaires, but the notch below that. A lot of times, great wealth is created by starting a great company that you grow and you scale and you maintain ownership, and it grows and grows until potentially you take an outside capital and or private equity and have a liquidation. What they often do with the cash flow coming in is they show discipline and strategic investing and invest in often in real estate. And in the US and most other countries, there's some significant generational and tax advantages to doing so. If you could let the audience know about that philosophy, may have waned a little bit here in the US, but when you look at Asia, when you look at the Middle East, is the concept of we start a business, we stay private, we stay under the radar, we take in lots of money because we're growing and scaling, and usually real estate and infrastructure, does that kind of form a backbone of their investment strategy?
Good. So, Angelo, there are two parts of this question. Let's talk about the exit opportunities for entrepreneurs in Middle East and Asia. We are pretty lucky here in US and pretty much in Europe that we have comparables available. So if you're building out a next Uber, you already know that there was an Uber or there is an Uber or Lyft. If you're building out a social media platform, you have multiples available to compare and contrast and price yourself. Unfortunately, international markets do not have that luxury to compare. So they have to go to a different market that is US and then get into a conversation whether it is the right comparable or not. So exit opportunities for private investors or private entrepreneurs are fairly limited internationally. So that leaves them with operating business incomes, creating holdcos and opening another business possibly with that opportunity. Having said that, there has been some good traction when it comes to M&A activity. So there are like larger players buying smaller players. I mean, same like if you look at Careem in Middle East, if you look at any other ride-hailing app or social media platforms internationally, that's happening. So that's one aspect of it. When it comes to real estate has significant, I would say, drivers here in US when it comes to generational wealth creation, whether you look at tax advantages, whether you look at the stability, regulations as well. But when you look at international markets, when I look at it from affluent to all the way ultra high net worth individual, it does not provide you with the same kind of tax advantage that we have here in US. So that leaves us with the debate whether buying that particular commercial property or multifamily, say somewhere in Singapore or Dubai, will yield the same kind of return if I say open up a family office here in US or buy something in London. And that's why you see significant amount of Middle Eastern wealth, if I talk about Middle East, invested into UK real estate or French real estate, also US real estate as well, but primarily French and UK. So that's from the point of view of thesis. If you look at the allocations, Asia Pacific, as I was mentioning, is one of the oddest region where public equities are overweight as compared to private or real estate and private equity or real estate investments. And when it comes to private equity, they are primarily investing into healthcare, they're investing into ed tech, wellness tech, things like that. That are more beneficial, more impactful for the overall ecosystem where they operate as compared to real estate that may be more isolated when it comes to impact. we need to understand that when you move outside of US, there is significant amount of nationalistic pride attached to these family offices. Most family offices are significantly close to either the ruling families or political figures. And for them to move the money outside of that region or invest into a region like Europe or US is considered bad or frowned upon or nationalistic. So that's the theme. So what is left behind are these private equity opportunity and public markets. Middle East is a little different. Middle East is having a ton of international. Middle East is having a ton of international projects that they are doing in joint venture partnerships with the U.S. and other international partners. But if you have seen NEOM or any other latest developments, they're bringing in foreign direct investment to Saudi Arabia, for example. Dubai and Abu Dhabi has been on this train for some time, I think over 2 decades now, and they have proven that model works. So you'll see even more countries coming out, bringing in international investors, which will possibly include bringing in brain as well from outside. So
true.
Exactly, international investors, entrepreneurs, creating economic hubs, startup ecosystem, so on and so forth.
I'm a little bit of a commentary about what's upcoming, and I'm going to lead it into a question, which is a very trendy investing topic and more right now. So many of you know when I have the launch of AngeloRobles.com, or officially on August 15th, a lot of what I do is the depth of my intellectual work of me and effectively what I call a dream team of amazing global thinkers on a limited number of topics that are investing and family office centric. And I think the work that I'm working on, and I'm 90 to 95% complete on 2 of them, 2 of my 3 master classes that will be released in person, maybe part of it digitally in the future, we'll see, but in person effectively over the next 9 months. This fall, I'll be rolling out what I believe are the most comprehensive master classes ever on creating a top 1% family office, whether you're creating from scratch or whether reimagining and redesigning. And my sovereign risk assessment in general, and AKA disaster prep for billionaires, those are kind of my life's work in the community. They're multi-day. It's not just me. It's incredible deep thinkers and thought leaders. And that is going to be available at a pretty significant premium. So this is something, if you're really, really serious about in a couple of days, going from here to here really quick, arguably even from 5 miles an hour to 150 very quickly, I know that I could do it. The part where the question is coming up is the third one I didn't mention, and that is going to be family offices and AI. One, from an investing perspective, and I think the opportunities are ridiculous right now, incredible. And I'm talking to a lot of the leading thinkers around the world, not just in Silicon Valley, Israel, and parts of Europe, but in Asia and Singapore. Incredible if you make some of the right decisions, but also the operational function, both the future of investing, but your family office right now. And if you want to work and continue to work in a family office and be viable, especially to a rising generation, if it's more of an older family, like there are lots of things happening. And there's not real depth of education in what I would call a in-person, multi-day, really deep, lots of quote unquote dream team thought leaders coming together and imparting incredible knowledge to you. So yes, this is going to be a premium. I already said that. I do higher level work, and I expect the people that would be interested to, let me know. Again, some of it will be promotional on some of the things I'm doing beginning next week with the launch and others. But stay tuned, or simply just email me, Angelo@AngeloRobles.com. It's simple to inquire and find out more. But that third one on AI leads to the question. The AI revolution, oh my God, is it real? The world is undergoing an AI revolution, I think comparable to the internet evolution and even going way back or revolution to the industrial revolution. Look at Nvidia. The earnings have just been incredible and ridiculous for, since AI has really come more to the forefront. How is the world, specifically Asia, looking at this and the impact on portfolios for allocators and investors?
Okay, let me take that question from family office perspective. And because I was involved with product development and somewhat AI in the past, I can comment on it from, I think, pretty basic point of view. Family offices face one of the biggest challenges of aggregation. That means if I've invested in real estate somewhere in Sweden, and I've also invested in public equities in Singapore, or if I have like 5 different RIAs that I work with, right? The challenge is having one dashboard view on my desktop. Still to date, it is not possible to see my net worth, see my position. There are vendors out there like Adapar. I don't want to name more, but there are vendors that are trying to solve that. But still, that remains to be a big issue. And hear me out. If data is a big issue, then I don't know what AI will run on, because AI is a train that runs on data rails, right? So same goes with Netflix. If I switch on Netflix and God forbid, if I am in someone else's profile, I mean, the kind of stuff that I see there is not aligned with what I want to see, from cartoons to Korean dramas. And if Netflix can solve that by my behavior, by clicks, by viewing habits, and show me what I want to see, I think it's about time where capital raising gets a little bit more smarter and intelligent, so that you don't send me 6 paragraph. I'm not talking about you, Angela. You never do that. But
oh no, of course not.
If people don't send 6 paragraph first time message on LinkedIn without knowing whether I invest in that asset class or not, I'm allocated or not.
That is so damn annoying. I hate that.
Exactly. I am the right person to make that decision or not. Should they be asking me for referral, or should they be asking me to invest? All of that data should be available on the capital raising side. On the flip side, data for family offices and high net worth individuals should be available as readily as they're watching Netflix. So if I have an interest in real estate, I should be able to get, I don't know, 30 different offerings that are available, direct and fund structures that align with my thesis, and then also simulation of outcomes. May or not, just like I may not like the movie that my favorite hero or characters are in, I may not like the outcome that is coming into the future when I invest in a certain asset class. All of that can be solved by data. Obviously, on the impact on the movie selection is much more minimal, or choosing the wrong movie is much more minimal. As well,
the consequences, yes.
The consequences on choosing the wrong movie when I'm in my family will be much higher, because then I will never get an opportunity to choose a movie.
All we have is time and energy, and you did take 2 hours plus of people's prime time. So
yes, but on the other side, the consequences for family offices will be much more higher. So data, and then on top of it, building AI models that will make decision making easier, less bias, and more wholesome.
And in terms of what you're seeing around the world comparative to America, is there interest in investing more in AI, especially more private markets? Is there hesitation, or in aspects of it, are they more gung-ho than many of us are?
I believe it works just the way any other like a market adoption works. There are people who are innovators. They're looking into it, and they're very active. And sometimes I get surprised, because I do have those inherent ecosystem biases that particular market may not be that sophisticated as they are right now, or I haven't gone to that market or looked at that particular segment for a long time, and now I see all of a sudden these ecosystem being developed. So there's that aspect of it. There's a lot of research happening. There's a lot of alignment when it comes to US and other AI center of excellences. But if you look at mass adoption, uh, a lot of people are more skeptical when it comes to investing in AI, just like crypto, because they still don't understand what AI can do for you, or what it can do for industry. And right now, I'm seeing investments in AI when you look at Asia Pacific or Asia into structures or companies that are more aligned with the operating businesses that those family offices are operating. So I'll give you a very recent example. There is a family office from UAE that invests in pharmaceuticals. They have invested in a proprietary software company that is investing in pharma tech or med tech. If I would have asked them to invest in, say, prop tech, I don't think so. I will get the same kind of reception. So, so family offices are more aligned with AI and technology when it comes to solving their own problem, because they understand the ecosystem. Once they get that particular investment under their belt, they can then go and talk to the ecosystem and their friends or competitors to acquire that kind of market advantage.
And a little bit of a housekeeping note, by the way, there will be one more live at minimum this week. It's going to be Friday at 2:00, and it features a pretty interesting guest. He's dynamic, a little controversial, more on the geopolitical front, but obviously that will dabble in economics, politics in general, and of course, investing. His name is Mark Moss. Many of you may follow him on Twitter. So that's going to be this Friday at 2:00 Eastern. I did make a commitment. I'll do it as a live. I thought about doing it more privately for my members and my more platforms that you're a subscriber to, but it's okay. Again, I want to give back all the benefits the community has given to me and do some value back to the community that I quote unquote give away for, let's call it, for free as well. A little bit out of left field, but do you think the Fed is finished hiking?
That's a good one.
And I wanted to surprise you with it, where you didn't see it coming. Half an hour ago, you would have felt it coming.
My personal opinion is yes, and that has to do with the political climate, upcoming elections, the narrative, so on and so forth. I know oil prices are not supporting that whole narrative and continue to push back on whatever good that's coming out of the economy due to higher interest rates. But that's what my thought is. Now, if data continues to come out the way it is, and that's in the past we have seen that Fed start looking at the data once it has happened twice or more. So it has happened once already, possibly next meeting, one more. And then when I say one more, means one more review and wait and see. And then possibly by the end of the year, we'll be in clear in terms of where we are heading. If we are heading into recession, we're keeping the interest rate the way they are. But one thing is for sure, I don't see Fed cutting the interest rate anytime soon.
Yeah, probably. I would look at you as being at least somewhat contrarian. You don't just go along with the herd. You think for yourself. And often, sometimes the masses are right. But to be a great investor, I think you have to think more like a contrarian. What causes you? This is the key question, though. What causes you as a contrarian to change your mind, to change your views?
And when you ask this question, are you talking about from the point of view of the market, interest rate, what sentiment?
More so the market and the thesis that you form on something that you have high conviction on. And now, if you had an ego, you would let ego step in the way of the new facts that are coming in. Imagine yourself like a poker player,
sure,
but everything is changing rapidly. You can't get married to one idea because what formed your thesis based on prior information, maybe even a week ago, could be totally different now.
No, you're right. I will answer this with one word: data. When I started my journey, I always felt that I'm right. I'm the only opinion in the room, and everyone should convert to my opinion. But
I know what that's like.
Yes, as you grow, and I'm not going to say as you grow wiser, Angelo, you
I hope.
realize that the world is much bigger than you thought. There are so many different perspectives and opinions. I celebrate diverse opinion and just diversity of any kind, and I'm ready to be proven wrong. Continuously learning every day. But having said that, there are certain aspect of my analysis that remain constant, and that is when I look at an event, I try to look at it from global perspective as to what is happening internationally, or what is happening here will impact international sentiments, and then it will boomerang back to us. Whether high oil prices, and I know you know where I'm going with that, or with regulations when it comes to crypto. If we're not going to regulate crypto, no one will. No one want to mess around with Uncle Sam, in at least in the short term. So we do have a responsibility to be the innovator, to be the first mover, so that the innovation can happen outside of our geographical boundaries as well, and continue to support us and this beautiful world that we live in.
To give the audience some context, as long as it's okay with the boss, we have about 20 minutes to go. We're going to very, very soon get into looking a little bit more in kind of rapid order around the world. But related to that, obviously, is geopolitics. We are in the early stages of a geopolitical turning point. As in the early stages of any regime shift, great opportunity awaits. But we are entering, I think at least, into a multi-parity world, I guess I would call it. What do you think for investors are the most relevant questions to me? And maybe you have a response to them about how someone should think for themselves and to think. The questions are, what will this new world order look like? Two, how will the transition unfold? And of course, the most important, but I think you got to get the first two in your thesis first, is where will the opportunities lie to get alpha, to get greater returns? I'm throwing a lot at you and probably want a relatively spiffy answer. How would you respond?
I think from looking at the opportunities, family offices, whether they're international or domestic, have to look outside of their domain of comfort. So that means if they're investing in real estate, they may have to look into ancillary industries like artificial intelligence that will obviously benefit them, but at the same time, opportunistically, they have to look at it market sentiment, look at it from the point of view of comparables that has happened in the past, opportunities that they have lost because they were overthinking, for example, all of those things. And I suggest my family office clients that always try to get answers from specialists. That means, like, if I cannot give you a tax advice, doesn't mean no one can, and doesn't mean that you shouldn't file your taxes. You should definitely go find someone who will help you with your taxes. So the same goes with like, for them, exotic asset classes like crypto or alternatives or private equity to some extent. They have to look at it from a learning point of view. So that means going to people like yourself, Angelo, understanding there is an aspect of opportunity that lies beyond their comfort zone. So that's where I think, in terms of the parity, I see world to be a little bit more balanced in the near future, and we are already seeing that. U.S. being outside of the war, at least directly, is at least for the it's a change from what we have seen in the past. A little bit of provocation, and we will nuke people and bomb people. So, and I'm not trying to minimize what has happened in the past, but I'm just saying that there are other ways to engage, and I believe the biggest and the most sustainable way is developing your economy to some extent, where going to war becomes more of a waste of time and energy. There will be other ways to protect your boundaries and supremacy. But with India, China coming up, I see there going to be more than one power in the world. when it comes to demand generation and impact.
Lots of questions on that, perhaps for the future, specifically on India. Whenever I talk to great thought leaders, all who know more than me, it is all over the place. It is absolutely look at the math, look at the numbers, look at the intellectual horsepower, look at a variety of perspectives. On the other hand, I hear still tremendous bureaucracy, lots of poverty, and to some degree can't get out of their own way. And you might be right, but boy, we might be talking 40, 50, 60 years. Okay, I said I was going to do that in the future. Give me a 1-minute response on India.
India, how can I start? Like, it's a long story.
I know.
See, there are a few things that are happening for India. Number one, obviously, the population. Number two, having one cohesive identity. I know there are several states, different languages, but at the same time, they all unite under the brand India. Then there is a huge amount of nationalism. People take pride in calling themselves Indian or using products that are made in India. There is a sentiment, obviously, that and it comes to luxury and things that are a little bit more sophisticated. But when it comes to staples, when it comes to day-to-day things, I've never seen this kind of sentiment in any other country but China. So India and China are more aligned when it comes to supporting local products, local entrepreneurs, local businesses, and so on and so forth, local stock market as well. India has seen an incredible growth when it comes to wealth creation. They're getting sophisticated. They have access to knowledge. Language is not a barrier. English is widely spoken at all levels of economy. Regulations are getting in. In fact, in some instances, they are better in the region than anywhere else. So having said all of these things, I see there's huge opportunity for American companies to A, invest or co-invest with Indian partners and family offices, and B, for Indian family offices to now start the journey to start their journey to a different dimension altogether. And that means a little bit more sophisticated family governance structures, for example, gender equity, women and wealth are themes that are gaining a lot of momentum. And staying on the same topic, I see family office community in US and Europe to be more receptive to the idea of having women-led family offices as compared to other sectors of financial industry or let alone wealth management, where women in finance are less than 20% of the overall financial advisor population. So that's happening. I'm seeing more a push in India than anywhere else when it comes to bringing in female representation into this wealth management industry, and also from next gen point of view, a lot of families are promoting their daughters, their wives, their sisters, and so on and so forth to lead their family offices, which is a great sign.
I see that as well in India compared to other parts of the world, 100%.
I'm seeing another trend in India now. Initially, I haven't seen that when I started tracking Indian family offices, is that bringing in international talent. So I'm seeing a lot of European CEOs or entrepreneurs who have exited their companies getting into family office space as the CEO or the CIO of the Indian family office, which is very interesting. Because with them, they bring in a different type of perspective, different cultural view, and also access to international markets, because they do have their separate own ecosystem outside of the Indian economy.
Excellent. Your former employer, Goldman Sachs, published a 2023 Family Office Investment Insight Report. I'm looking at it now, and I'll ramble off what allocations are to various, let's call it asset classes. 28% to public markets, 26% to private companies, aka private equity, 12% to cash, excluding treasuries, 10% to fixed income, 9% to private real estate and infrastructure, 6% to hedge funds, 3% to private credit, and a lowly 1%, which surprised me, lowly 1% to commodities. That seems a little low to me. What do you think?
And Angelo, if just housekeeping comment from my side, I do have low battery. If I lose you for any reason, I will, well, low battery reason, I will join in from my phone right away. So you can
Of
continue
course,
with your
I'll do a comedy routine for 2 minutes until you get
or a
all
song.
good.
So, Angelo, when we look at data, whether you look at any family office report, UBS, Goldman Sachs, Morgan Stanley, or JP Morgan, you're looking at the data that is aggregated across the industry. So when I look at commodities, if you look at, say, Middle East is, to some extent, I would say Africa as well, a little bit more heavy on commodity allocation. But when we get to, say, Asia Pacific, for example, or we look at India, for example, that access is not there. And when I say access, that means family offices do not have access to education, B, connectivity with opportunities that will give them intelligence, data, and also comparable when it comes to commodities. They're more used to of keeping the money either in their businesses. Then comes, as I said, in Asia Pacific, private equity, leaning towards more healthcare and other kind of private equity that interests the family offices, and then comes the real estate. So when it comes to commodities, unfortunately, the access is very limited, and it is limited to only family offices that actually seek that particular asset class. When you look at financial advisors or private bankers, they're not also trained, and I'm saying that with my own personal
Definitely
experience.
true.
They're not trained how to handle this conversation from a team point of view, especially introducing that team. A ton of family office advisors reach out to family offices that are already investing in commodity, as compared to reaching out to family offices that are not investing in this and building that thesis. One of the things that I've told my teams in the past, that when you reach out to a family office, say, for example, investing in real estate, don't reach out to family offices that invest in real estate, because then what? They're going to steal your deal, compare and compete, and C, it's never going to be a conversation that you will like towards the end, if they are pleasant with you. So it's ideal to reach out to family offices or investors that are not traditionally institutionally investing in family office in real estate. So, for example, tech, pharma, healthcare. All of those family offices and traditionally have been more receptive to my real estate pitches as compared to family offices that have invested in real estate.
Excellent points. And in the final stage, probably the final 10 minutes, we'll take a kind of a look around the various regions. And I'd like to apologize. In the regions that we've been talking about, I did leave out, and I met someone for breakfast this Sunday morning where we
South
spoke
America.
about it. And yet I forget to bring up Africa. My bad.
Africa
I think
and
there's
South America.
and yeah, like a little bit of my cultural heritage. So again, we got like an hour and 20 minutes. We can't cover everything, but my bad. I think there's incredible things happening broadly in Latin America. And I think Africa is one of the few areas where the population's going up, incredible natural resources. Yes, there's lots of challenges, but there's going to be incredible wealth made both locally there and people that strategically allocate. So, and I think there's wonderful and amazing people in both those regions. So, my bad. And on that note, showing a little bit of due respect, why don't we actually start there? Why don't we actually start initially with the content of Africa? Your perspective of how the wealthy are allocating, both those that are making money and growing their wealth and resources internally, and those that are investing from the outside into Africa.
Let me start with similarities between South-South, so Africa and South America. African high net worth individuals and family offices are using tried and tested model of multifamily office, things that are very famous in South America. Now they are gaining traction in Africa. Part of the reason is just the culture, because they want to be together. They want to leverage the collective intelligence around a certain asset class or that movement. And B, the opportunities are not there when it comes to sophisticated wealth management and planning. Most of these family offices are either opening up in Europe or they're opening up in Dubai. I've seen quite a few family offices open up in Dubai that are representing African families. Singapore is another one that is in the running. So that's happening when it comes to similarities. When it comes to uniqueness, same challenges, because we don't have family office advisors or let alone financial advisors in major pockets of opportunities. Most of those opportunities are serviced by either South African or Kenyan private bankers. To some extent, Egyptian private bankers and Moroccan family office advisors are covering that. But at the same time, if you look at the culture, same goes with South American culture as well. There is a certain level of dislike for suitcase bankers. So that means you fly in, you meet with a client, you fly out, you have dinner, you fly out, right? And that just lacks personalization, that lacks the warmth. And family offices need you on a day-to-day basis. They may not call you, they may not email you, but there is an aspect that they may need you within 30 minutes or 2-hour notice when it comes to
absolutely.
So, and then the opportunities come in from all directions, including political connections, media, other conglomerates in the region that are very connected with each other. So this is providing an opportunity, at the same time challenges for African high net worth individuals. Now, how that can be serviced, I mean, it's anyone's guess. I feel larger brands are not very successful when it comes to African or Latin American families for obvious reasons. I'm thinking that they somehow are connected or ancillary or a satellite office of Uncle Sam. So that will be a challenge for them. But local brands, and especially Middle Eastern brands, opening up in Africa, and then a lot of Brazilian and Argentinian multifamily offices expanding into tertiary markets like Peru or Colombia, and other markets as well. So I'm seeing this movement happening. It is still nascent. Still, London, New York, Paris, and Singapore and Dubai continues to be the centers of these family office activity. I would love to see more offices open up in Kenya and outside of, say, Joburg and Durban.
Yes, my experience beginning to do more work in private coaching and consulting is a lot of families in those regions. One, the wealth is definitely fast growing. It's definitely there. Yes, they do tend to look at London, Dubai, and Singapore more so than a couple of years ago. They would have looked at more New York. Miami has taken some luster broadly from New York, and there are advantages I'd like to hope to still here in the US. But you have to realize, from an international family's perspective, the world doesn't always revolve around only the US. There are, like I said, changes occurring. It's becoming more of a complex world. Having a level of diversity. One of the things I talk about for US families is to be diverse. And actually, I think they should, among their probably 5 to 6 passports, have one that is in the continent of Africa. But again, maybe not the subject of today. Given that, again, your phone may die, we have a limited amount of time. Let's continue in terms of trends you're seeing. How about in the Middle East?
I'm seeing an increased trend for co-investment opportunities within the region. I'm seeing less and less of Middle Eastern investors investing in US, and a part of, and it has to do with politics, but primarily local markets are being developed now. So there were no alternative. Now they have alternatives available. So why not? So that's the trend that I'm seeing broadly in Middle East and India. If you look at Asia Pacific has always been a very close ecosystem. Everything gets invested within the region. Very little of that leave that region and goes to, say, established centers like London or New York, but very little of that. I'm seeing a lot of Latin American families moving their allocations to North America. And I've written that a few weeks ago that for us, it may be a higher interest environment. It may be political chaos. It may be regulations that we don't like when it comes to local businesses here in the U.S. But for a lot of countries in the world, and I'm not just singling out Latin America, but Africa, Asia, Middle East, South Asia. For them, it's about stability and survival. So
Yes.
when it comes to moving money or allocations to US or Europe, it is also for next gen and continuity and legacy building, because they really don't know at what point they will lose that livelihood to one political mismove.
Yeah, we're not as used to that in the US, although it is a subject that I do talk about. You have to wake up. There are things that one could go wrong here and have gone wrong around the world for a long time. There are
Yes.
wars. And by the way, well, we have our laws and our constitution. When you're at war and you're being invaded, the other country doesn't, I was going to use a harsher word, they don't care about your laws and regulation. They just go and
Yes.
take your stuff, period. You
Yes.
don't think your own government could fabricate charges against you and make it difficult to defend? You don't think they could, at minimum, freeze your assets, if not outright take them? And you can't take your real estate or land with you. They may just flat out even alter the title. Now, yes, you may be able, with proper record keeping, decades in the future to argue that and get some representation of resources back. What I am saying, again, especially for the super rich, and I've seen it, I've traveled the world, I've spoken to families, there are things that absolutely could go wrong. They are less likely to happen here, although
Yes.
a lot worse in the last 5 years than what I would have said 10 or 15 years ago. Unfortunately, it looks like we're losing Abbas. I'll give a closing comment. He may bounce back on his phone in like 5 seconds. Of Abbas, you are quick. He's probably still waiting to, we could see Abbas, but he's probably transitioning from his phone where we could hear him. Abbas, if you could hear me, just chime in. But wow, that was only like a 10-second break. So this was a lot of fun. Hopefully Abbas will come back for the final 5 minutes. He's a great guest. He's becoming a new friend of mine and like indirectly part of my dream team that I mentioned earlier. So hopefully he'll have a chance to bounce back in a second. First of all, most important, go and follow Abbas if you don't. That's Abbas, last name Hashmi. Again, last name H as in Harry, A S as in Sam, H as in Harry, M as in Mary, I. He's a great LinkedIn follow. I'm not sure if he's on Twitter, but look him up. Definitely have a chance to learn more about him and his company. I think he's a wonderful thought leader. And it really was exciting today to go over some economic and macro and a little bit of geopolitical, all subjects I love. Hopefully bring it back somewhat to family offices and investing. Wish we could have perhaps had a little bit more time. I would like to have discussed Mexico a little bit, go back a little bit more to LATAM, and talk a little bit about some of the differences between larger scale US families and other families around the world. Although I think we hinted at it, there's just a lot more risk for many of them relative to their cash, their positions politically in country, things that could go wrong. And they still would look at countries like the US and Switzerland, or depending on the part of the world, perhaps London, and definitely growing Singapore and Dubai. I've done multiple work, not only creating international family offices relatively recently and taking on a lot on my plate, but US families recommending that they have diversity. Sometimes, if they're very large, a satellite family office in one of those destinations that I would have referenced. And there's others. So lots more to come. Hopefully, I know a little bit. I have a little bit to impart. I know great people. That's even more important than me. And the opportunity for sharing some of that Rolodex and interviewing them is really, really exciting for me to do. I hope you're all enjoying it. And again, just follow me on all my socials, especially my LinkedIn and my YouTubes, YouTube being at Family Office and Family Office TV. Go and subscribe. Do more super chats. Be supportive. I'd appreciate it. That'll motivate me to do more lives and give back to the community as well. And I'm also on unique platforms that I'm still feeling out and will roll out more a little later this summer on Rumble at Angelo Robles Media and even Twitch. And again, I'm still kind of figuring those out, but I know Rumble is totally free speech and can have very open and honest discussions. And I may throw out an F-bomb here or there as well while I'm having a scotch and smoking a cigar. All things I'm not so sure that I could do on the other platforms. Well, thank you. Thank you so much, JW. Keep the comments coming. Send me emails. Reach out to me. Again, that's Angelo at angelorobles.com. The revamped website, which will be significant, talking about those master classes that I noted, my private coaching and consulting, my private membership group, and the work I'm doing in my creation of Billionaire University and Billionaire Mastermind. Hopefully, me and my dream team and other new, great, amazing people, many of you that I'm meeting, I look forward to interacting and engaging you all in my world and my community, and me learning from all of you. So much I could learn. And even in the last week, so many of you have reached out. I greatly appreciate it. Thank you for your support. And again, angelorobles.com, specifically beginning next Tuesday, is going to be far more detailed. Engage in what I'm doing. You're just getting the 1% of it now, and I'm happy to do that. But to really be a part of our community and what we're doing, and so I could grow my team and the resources to be of value to you, it's important to be supportive and hopefully see the value in what I'm providing as well, and take pride in the work that I do more intellectually with families around the world, and the work in my master classes that I'm very proud of. And I think it's very unique, very detailed. Again, I'm really not impressed, and I've been in the community for 20 years, with 99% of what I see being outputted in the so-called family office community or those that service the community. So hopefully the benchmark is pretty low, but I want to do great no matter what. And I can't do that not only without all of your support, both following in social and being supportive, but in other aspects as well. And also reaching out and sharing information and things with me so I could keep on learning. I appreciate it. Thank you all so much. And again, although we were not able to get him back, Abbas Hamshi, Hashmi, you got to follow that guy. He's brilliant. I love his work. Thank you all so much. Until next time, which at least in a live appears to be Friday, 2:00 Eastern, with a one and only, you got to follow that guy on Twitter, Mark Moss. Can't forget that name, Mark with a K, Moss. And that's going to be mainly geopolitical. That'll be a lot of fun. Hope you enjoy it. Thank you so much.